I'm revealing my entire $360,000 investment portfolio, and I'll be walking you through the 4 largest positions in my portfolio and explain why I'm holding these for the long term. You will also learn about how I actively manage and rebalance my portfolio using 2 crucial investing concepts: concentration and diversification. I'm Eric Pan, aka Ericnomics, and my vision is to make investing concepts and strategies simple and actionable. So whether you're a beginner or already investing, my content will provide you new insights about stocks and crypto investing opportunities. Heading into the new year, I want to set the tone by being transparent with my personal stock market investing portfolio. I don't think having a $360,000 portfolio makes me any more special than anyone watching this video. However, when I was learning about investing, I personally wish there was more transparent and well-explained educational content for me to learn from the actual process behind somebody's growth, rather than a bunch of claims that was not backed by any research or results. Being transparent with my growth is also a great reminder for myself on how far I've come and how important it is to stay disciplined. I was once a 9-to-5 worker who was grinding the corporate ladder until my 30s, and thanks to investing and the power of compound interest, I'm able to achieve financial freedom. It took me years to build this 6-figure portfolio that generates gains and dividends for me to cover my expenses and focus on creating investing content that provides educational value. If you'd like to see more real portfolio updates and actionable investing tips, please hit that like button and join me in the comment section down below and share your thoughts and questions. The first section we're going to be talking about is my portfolio overview and concentration on the tech sector. This on screen is my entire stock investing portfolio between my taxable brokerage and my Roth IRA. I'm a verified user on this investing social app called Blossom Social. My investing accounts are all linked to Blossom, where you can see my entire portfolio, including what I buy and sell in real time. These stocks are sorted from largest to smallest percentage of my entire portfolio. So as you can see, my largest position in my portfolio is currently Tesla, representing about 21% of my entire portfolio, or $72,000. Next is 19% of my portfolio in Microsoft, or about $65,000. Further down the list is I'm also heavily invested in Meta and TSM. These 4 leading stocks make up about 60% of my entire portfolio. So now you might be wondering, why am I not heavily invested into ETFs like SPY or QQQ instead? And the truth is, I'm currently investing in over 15 different types of ETFs. One's from tracking the 500 best performing companies in the US to specific industry ETFs such as semiconductors or healthcare ETFs, and even ETFs for Bitcoin and Ethereum. You can see all the ETFs that I am investing in on my Blossom profile. However, they are currently a relatively small percentage of my overall portfolio because of my current concentration strategy. I'm currently actively concentrating in tech, so when I'm more bullish on a certain sector, my strategy is to shift those funds towards those leaders in that specific sector. Using tech sector as an example, the leaders in this space are also driving AI development such as Microsoft, Meta, and TSM. Here's a bit about my style of investing. As a manager of my own portfolio, I like to actively monitor the markets and stay updated with current market sentiments, what's going on with the hottest sectors, and what is likely to happen in the next few months. So my style of investing is less passive, and I like to be actively managing my portfolio about what I'm buying and selling in smaller share sizes. And the idea of concentration is the opposite of diversification. I like to think of concentration as my offensive weapon and diversification as my defensive weapon. Concentration versus diversification. Let me give you a quick tutorial on concentration versus diversification. These are 2 strategies that every investor needs to understand and apply at different points in their investing journey. Concentration means that I am focusing on a significant portion of my portfolio on a few select high conviction stocks. Right now, these companies are like Tesla, Microsoft, Meta, and TSM. As we're currently in a bullish market cycle, these 4 tech companies are the respective industry leaders within tech. What they all have in common are strong fundamentals in terms of revenue, and innovative visions, and the potential to deliver outsized returns. Let's take Tesla for example. Not only is Tesla the leader in the EV market, but they're also revolutionizing energy storage and AI-powered autonomous driving. I see Tesla as a massive growth opportunity, and that's why it's respectively about 21% of my entire portfolio. Concentrating my investment here is my way of seizing and timing the opportunity and going on to full offensive mode, aiming for a higher return growth on the Tesla stock. The more that I keep increasing those concentrations of these stocks, I'm also increasing the risk exposure of my portfolio. When you put a large portion of your portfolio in just a handful of stocks, your returns depend heavily on those companies performing well. If Tesla or Microsoft were to face major setbacks, it would also be a noticeable impact on my portfolio as well. That is why I only concentrate in companies where I've done my due diligence with extensive research into their financials, competitive advantages, and future potential. Look, concentration isn't gambling. It's about taking calculated risks and closely monitoring your portfolio to rebalance whenever necessary. So far this year, concentrating on big tech companies that have a hand in AI has been an extremely profitable strategy for me. And for reference, I'm up about 93% on Meta, 62% on Tesla, 7% on TSM, and 5% on Microsoft. I got in a little bit late on those last two, but that was only after doing some due diligence and I felt like there was more upside potential there. The key lesson is that investing is all about strategic planning. The good thing is that you don't have to rush into it because investing is playing the long game. Doing things like reading the latest news, reading the company's profiles, analyst ratings will help you tremendously for your investing journey. We all live in an age where there's tons of free resources out there to help you along the way. Once you develop the routine of staying informed, investing opportunities will come naturally under your radar. When you feel like there's more and more potential buying opportunities given the market, this is when you should be applying diversification across different assets to reduce your risk. For example, looking at my portfolio right now, I hold SPYV, which is the S&P 500's value ETF, which is a little bit more stable than the regular S&P 500. And like how I hold KWEB, which is CraneShares China's internet ETF. This also gives me overseas geographical exposure just in case the US economy takes a nosedive. So, even though I believe in concentration, I'd also personally say don't have more than 25% of your entire portfolio in a single stock. Otherwise, your single stock risk is way too high. And now, if you really want peak diversification, then get an ETF that covers these areas: geographies, sector, market cap, commodities, and asset classes. So for example, for geographies, get a China ETF. For sector, get a healthcare or financials ETF. For market cap, get small cap and mid cap ETFs. And for commodities, get a gold ETF. And then lastly, for a asset class, get a crypto ETF. Diversification is really crucial in the grand scheme of investing because it protects us against the unpredictable. No matter how much research you do, how accurate you are with your stock picks and predictions, there's always going to be a black swan event around the corner, like market crashes or unexpected regulatory changes that can even derail the strongest companies. So diversification is your safety net for when those things didn't go as planned. How I balance both. So how do I use both strategies? And the key is to find the right balance between offensive and defensives based upon three major criteria. Number one, your investing goals. Number two, your risk tolerance. And number three, the current market conditions. Now, your investing goals are like the compass to your portfolio. Are you aiming for aggressive growth, steady income, or wealth preservation? For me, my primary goal right now is growth, given the current market conditions. That's why I'm concentrating 60% of my entire portfolio in Tesla, Microsoft, Meta, and TSM. My portfolio is currently leaning towards the more aggressive end, where I'm more aggressive and I'm aiming for higher returns on the companies that I believe in shaping the future. If your goal is to grow your wealth quickly, you might consider a higher concentration in high growth stocks like how I have. But if you're closer to retirement, you need more stability and you want to lean a little bit more towards equal weighted diversification, and a good way to achieve that is through ETFs. And that's how I like to revisit my goals regularly. If my risk tolerance or focus shifts from generating wealth to generating steady income, I'll start to reallocate some of those funds to dividend paying ETFs or stocks that provide steady cash flows. Next, risk tolerance. Let me be direct with you. This is personal. In investing, nobody should decide for you how much risk that you should be taking. When beginners ask me how much should they be investing, my honest answer is it depends how comfortable you are with seeing your portfolio fluctuate. Let me give you a real life example. When Tesla dropped over 75% last year, I wasn't really panicking because I understood my risk tolerance. I know that Tesla is a volatile stock, but I'm okay with it because I believe in its long-term story. However, if another stock in my portfolio dropped about 20%, I would probably reconsider my strategy and potentially cut my losses. So everyone certainly has a different level of risk, and even internally, we would have a different level of risk preferences for each individual asset as well too. Personally, I balance my risk by having about 40% of my portfolio diversified into ETFs and a bunch of smaller positions in various companies, even when I am in full offensive mode. Knowing how much risk that you can tolerate and adjust accordingly is your secret to long-term success in investing. If losing 20 to 30% of your portfolio value would keep you up at night, you might want to dial back your concentration and add more diversification. Again, ETFs are a great way to do this because they spread out your investments across multiple companies. Over time, when you have gained some experience in the market from being a beginner to a more seasoned investor, the key skill to sharpen is to understand current market conditions and adapt your strategy accordingly. The market environment plays a huge role on how I balance concentration and diversification. Right now, we're in a bullish market cycle with strong sentiment around tech and AI, and that's why I'm heavily concentrated in leading companies in the hottest industries. Back in 2022, during the bear market, I leaned a little bit more into diversification. I increased my positions in defensive sectors such as healthcare, consumer staples, and even added a little bit of bond ETFs for stability. But now, with the market favoring tech, I've shifted back to a little bit more concentration and offensive play. The key here is to stay flexible. The market changes and so should your portfolio. If I were to see signs of weakness in tech, I would likely reduce my exposure on those concentrated positions and move those funds into a little bit more defensive sectors such as energy, utilities, and healthcare. How I rebalance my portfolio. So how exactly do I rebalance my portfolio? It's a mix of regular check-ins and making adjustments based upon the 3 criteria I just mentioned. But let me give you 3 simple steps to follow. Step number 1, set a numerical threshold for rebalancing. So, for example, if Tesla grows more than 25% of my portfolio, I might trim that position slightly and reinvest those proceeds into ETFs into other sectors to maintain that balance. Step number 2, diversifying into underperforming sectors if you anticipate a strong rebound. As an investor, I really like looking at underperforming sectors that have strong long-term potential. For example, the crypto sector after the 2022 sell-off. Did I know that crypto would be absolutely crushing it again in 2024? Maybe, but I can't predict the future. But I had a really high conviction in real-world value of Bitcoin and Ethereum. I also believe that this sector would rebound, but just wasn't sure how long it would take and how much. More importantly, I wouldn't know how strong the rebound would be and how much percentage gains that I would be targeting. So instead of betting my money on specific sectors, I picked Coinbase stock and ETFs for the crypto sector, such as IBIT. Diversifying into underperforming sectors allows me to capitalize on sector rebounds and further diversifying my asset classes, helping me spread out my risk more evenly. Step number 3, review your portfolio quarterly. I look at my portfolio every 3 months on a really deep dive to ensure that it aligns with my goals and the current market conditions. If a new trend emerges like clean energy or biotech or whatever it might be, I'll reconsider allocating some of those funds to take advantage of it. Balancing concentration and diversification isn't about choosing one over another. It's about knowing when to use each based on your risks, your goals, your market conditions, and everything. Balancing concentration and diversification isn't about choosing one over another. It's about knowing to use each of those based upon your goals, your risk tolerance, and current market conditions. What about you? What are you focusing a little bit more on, concentration or diversification? Let me know in the comments down below. So that was a walkthrough of my stock investing portfolio. You could follow me on the Blossom Social Investing app and get notified whenever I buy or sell a stock for free. Please drop a like on this video if you learned something new today. I also manage a structured investing community with real-time guidance and market insights. So if you're interested, feel free to take a look at the link in my portfolio for the Financial Framework Investing community in the description down below.